On this week's episode of the Crushing Debt Podcast, evictions, foreclosures, student loans, relief packages, and moratoriums.
Welcome to the Crushing Debt Podcast with your host, Florida attorney Sean Yesner, where our goal is to help you get rid of the financial bullies in your life.
So welcome back to this week's episode of the Crushing Debt Podcast. My name is Sean Yesner, owner and founder of Yesner Law. I'm recording this episode the day after the inauguration of President Biden. This episode is not intended to be political by any means, but I did want to convey some facts about eviction moratoriums, foreclosure moratoriums, student loans, relief packages, all those different types of things. And so that's my intent here today. But before I get started, like I do at the beginning of nearly every episode, I do want to comment on our sponsor, Sam Cohen with Attorneys First Insurance. And so if you are an attorney or a title agent, title company, and you need a quote for errors and omissions insurance, malpractice insurance, E&O insurance, all the same thing, contact Sam at sam@attorneysfirst.com or www.attorneysfirst.com. If you are not an attorney or a title company, but you know an attorney or a title company, please, pass their information on to Sam, or please pass Sam's information on to them so that they can get an apples to apples quote when it comes time to renew their policies. And so that would help me out very much and would help out our sponsor very much. But about a week ago, I did a presentation to the Rotary Club at Indian Rocks Beach, which is out here in the Tampa Bay beaches area. And so I wanted to take those notes from that meeting. I've updated it with a few more statistics now that we've got the inauguration done, now that President Biden is starting to issue some executive orders. I wanted to update it a little bit. And so I wanted to convey all of that information to you. So the first thing I wanted to talk about was evictions and the eviction moratorium. Now, what state of Florida and a lot of other states put moratoriums on evictions and said, we're not going to allow evictions. Then the CDC came out and said to prevent the further spread of COVID, to prevent people from moving into homeless shelters, moving in with non-relatives, moving in with people that they don't normally share a house with, which would cause the further spread of COVID, the CDC put a moratorium on evictions, put a hold, put a freeze on evictions. Now, what the CDC said is that if the state has as strict or more strict eviction moratorium requirements, then the CDC wouldn't apply. Now, in response to that, the state of Florida and a lot of other states said, well, if the CDC is covering the moratorium or the postponement on evictions, then the state of Florida eliminated by executive order its restriction on evictions because it's covered now by the CDC. In other words, we didn't need a belts and suspenders approach when either the state or the CDC would cover. And since the CDC is a federal entity, then, the state of Florida pulled back its restrictions, as did a lot of other states. So this is not an issue limited solely to the state of Florida. Now, the eviction moratorium originally expired December 31 of 2020. It was then extended by President Trump to January 31, 2020. And as I understand, President Biden has now extended it to March 31, 2021. And so I think I might have said January 31, 2020 before. I meant January 31, 2021. And that has now been extended by executive order by President Biden to March 31 of 2021. And I hear rumor, although I haven't been able to confirm this anywhere, that Biden might extend the eviction moratorium into September of 2021. Again, I heard it or read it in one article, I think from the New York Times, but I haven't seen it confirmed anywhere since. But I do know for now the eviction moratorium is in place until September 31, 2021. So what does that mean? What it means is that someone cannot be evicted for the failure to pay rent. And so an eviction is defined by the CDC as any action to remove or cause the removal of a covered person. Now, the interpretation here in Tampa or Tampa Bay, so Pinellas, Hillsborough, and I believe Pasco and some of the surrounding counties, the analysis here is that the lawsuit itself is okay to be filed. but the landlord cannot get that final writ of possession. The landlord cannot get that final thing that kicks out the tenant. So filing the lawsuit is okay, but then it has to stop before the execution, before the enforcement by the sheriff of the writ of possession. So again, the definition is any action to remove or cause the removal of a covered person. So who is a covered person? Well, a covered person has to meet 5 criteria under the CDC. Number 1, they've used best efforts to obtain government assistance for rent or housing. Number 2, they made less than $99,000 on last year's tax return as an individual, or less than $198,000 joint with their spouse, or they got a stimulus check under the CARES Act. That's number 2. Number 3, they're unable to pay full rent due to the loss of job, decrease in income, or extraordinary medical expenses. Theoretically, medical expenses due to care under COVID. Number 4, they are using their best efforts to pay. So whether they paid $1, $100, $500, they're using their best efforts to pay something to the landlord. And then number 5, the eviction would make the tenant homeless, cause them to live in close quarters or shared living spaces. Now, it is not the landlord's responsibility under the CDC guidelines to inform the tenant or the court of this. It is the tenant's responsibility to go to the CDC's website, find the CDC affidavit, and then file it with the landlord and with the court, which is what I would suggest. File it both with the landlord and the court. So what would a landlord do when confronted with one of these affidavits? Well, if the landlord believes that the tenant does comply with all 5 of these elements, then the landlord cannot evict the tenant. If any one of these elements does not apply, the landlord can challenge the affidavit, and if the landlord wins, the landlord can then evict the tenant. So what would be a good challenge to one of these? Well, what if the landlord, one argument may be that the tenant has not done everything they can to lower expenses. So they still are paying a cable bill, a Hulu bill, a YouTube TV bill. They're paying all these streaming services, Disney Plus, and they're unable to pay the landlord. Maybe they just bought a new vehicle and they have a really extraordinarily high car payment. You know, something that as a landlord, you may be able to argue that, wait a minute, they're paying all these other things that they don't need. People don't need cable and YouTube TV, and they're not paying me. That might be enough for a court to say the CDC affidavit doesn't apply. Maybe using best efforts to pay. Maybe if there is someone that they can live. You know, maybe this is a single person that is constantly spending time with his or her significant other. Maybe you can show that, you know, because they're spending a significant amount of time with their significant other, it wouldn't cause them to be in close quarters or shared living because they're already doing that. So again, each case has to be looked at on its facts to determine, does the CDC affidavit apply? Now, another thing, this only applies to residential. So for commercial tenants, the CDC does not apply. You can be evicted for the failure to pay rent if you're a commercial tenant. So this only applies to residential. The other thing is it only applies to a failure to pay. So if there are other reasons that a tenant could be evicted, they're conducting illegal activity on the premises, they're causing waste or disrepair to the property, they're damaging the property, committing waste on the property, if they're having multiple people live with them who are not on the lease, if there's a no pet clause and they've taken in all these animals, you know, other reasons under the lease for a default is grounds to evict a tenant. And sometimes, even if they're not making payments, if there are other grounds for eviction, I would raise those grounds if I was the landlord. We are finishing a case right now where the lease expired October 31 and the landlord chose not to renew it. And so we are evicting because the lease was not renewed. Now, if the lease was not renewed because the tenant was failing to make payments, I think the CDC might apply. But in this case, there was just a lot of bad blood between the landlord and the tenant going on for months, going on almost since the inception of the lease agreement. And so the landlord said, I don't care about payments. I don't care about money. I don't like this tenant living in my house. And so I'm evicting because the lease is over and I'm choosing not to renew it. And the judge agreed and granted us an eviction on those grounds. So with the eviction moratorium, you've got to make sure that the CDC applies, that it is for a non-payment of rent. If it is for any other reason, the tenant could be evicted in a residential situation. The CDC is very specific to say that it does not eliminate the requirement to pay rent. So if we get to March 31 and the eviction moratorium is lifted and the tenant is 12 months behind, the tenant has to come up with 12 months. Otherwise, the tenant could then be evicted at that point unless President Biden extends the eviction moratorium beyond March 31 of 2021. So it does not eliminate the requirement to pay rent. The effective date of the moratorium is September 4, 2020. So any eviction prior to that would be okay. Any eviction after that could, and by eviction, I mean the sheriff is actually executing on the writ of possession. Any eviction after that could be in violation of the CDC guidelines. Now, the relief package, and it hasn't been passed yet, but this is what I understand is proposed in President Biden's relief package. There's going to be an apportionment of $25 billion earmarked for rental assistance. It should be available now. It should have been available by the date of the inauguration, by January 20. So it should be available now. Now, if you're listening to this episode the day it comes out, a week, a month after it comes out, then that should still be good. If you're listening to this episode in 2022 or 23 or beyond, I make no promises. We got to update some of this stuff. But the rental assistance should be available by January 20. It is up to 12 months of unpaid rent. Now, more if the money doesn't run out. But frankly, I think we're going to blow through that $25 billion as a country really quick, and I'll get to that in a minute. But it is up to 12 months. So the tenant could apply for rental assistance in March, get 12 months of payments in March, pay that to the landlord. Now, one problem that I see with this is that it's the tenant that applies for the rental assistance. And so if you're a landlord, you've got to hope that you have an honest, trustworthy tenant, because theoretically the tenant could apply for 12 months of rental assistance and then not pay you that rental assistance. Now, I don't know what's going to happen in a situation like that. I don't know if the CDC would apply. Now, looking back at the CDC guidelines, number one, yeah, they did use their best efforts to obtain government assistance for rent or housing. But then number four, they use their best efforts to pay. So if a tenant gets rental assistance from the government and then goes out and buys a car instead of paying the landlord its rent, then theoretically I don't think the CDC would apply because the tenant did not use their best efforts to pay. Instead, they took that rental assistance and bought a car or a TV or a whatever. And so I think under those grounds, yes, the CDC would not apply. The tenant could be evicted if they got rental assistance and they did not pay it to the landlord. Now, of the $25 billion of rental assistance, I understand $1.5 billion of that is allocated to Florida. Now, that should cause a couple of question marks because you got $25 billion. So if we just divide that amongst 50 states, forgetting territories and whatnot, if we divide $25 billion, that would be a $500 million or $500 million per state. But Florida has 3 times that allocated to it, $1.5 billion. So that means other states are going to get less than $500 million in rental assistance, a lot less than $500 million in rental assistance. So good news for Florida, bad news for some other states. Again, up to 12 months if the funds do not run out, but how quickly is Florida going to blow through $1.5 billion? How quickly is the federal government going to run through $25 billion? I guess we'll see. And then is the moratorium going to be extended beyond March 31 of 2021? We'll see. And how does some of this stuff shake out? We'll see. I think this is going to have major impacts on the housing market, major impacts on the investor market, major impacts on the economy. So we'll just have to see how it plays out. The next thing I want to talk about is the foreclosure moratorium. Now, the foreclosure moratorium has a couple different aspects to it. First, we've got the FHA, the Federal Housing Administration. That's the FHA and HUD, basically. Now, that was ended December 31, 2020, like the eviction moratorium. That was extended by the FHA to February 28 of 2021. And then again, under the executive orders signed by President Biden, that's now extended to March 31 of 2021. So until March 31 of 2021, there is a foreclosure moratorium if you have an FHA or HUD mortgage, meaning if you have an FHA mortgage and you're not able to make your payments, they cannot foreclose. Now, I think it is the same concept that they cannot schedule the foreclosure sale. But I think the way that the FHA and HUD have interpreted this is that they cannot file or prosecute the foreclosure case at all. So those are still sitting out there. And I've got some facts here in a few minutes that'll give some insight into some of these statistics as well. It also applies to the Federal Housing Finance Agency, the FHFA, and that's Freddie and Fannie basically. Now again, that was ended December 31 of 2020. President Trump extended that to January 31 of 2021, and President Biden has now extended that to March 31 of 2021. So same thing. Freddie and Fannie cannot foreclose until March 31 of 2021, and that applies to foreclosures and REO evictions. REO stands for real estate owned. REO means that the lender has taken back the property and now the lender owns the property. So if you live in a home that was foreclosed, whether you owned it or whether you're a tenant, I don't know that Freddie and Fannie, FHA, HUD, VA, all those other government-backed entities, I don't believe they can evict you until at least March 31 of 2021 again, unless the president extends it again. Now, the CARES Act did impact forbearances. And again, so the CARES Act does apply to FHA, VA, the USDA, HUD, Fannie, Freddie. And so what the CARES Act says, because again, like evictions, this is not saying that the money is not owed. The back mortgage payments are still owed. And so the banks were required to give forbearance plans. Now, those of you that have been listening to the podcast for any length of time know I am very much against forbearance plans. And I'm very much against a lot of these policies that the former president and the current president is putting in place because we're just kicking the can down the road. And as a foreclosure, defense, bankruptcy attorney in this area, kicking the can down the road is never a good option when I'm speaking one-on-one with a client, or very rarely is it a good option. So if it's a bad option for my clients, it's a bad option for the federal government as well. But this is what they've chosen to do, and presumably there's people at the federal government level that are as smart or smarter than I am. So again, we'll see if it works out. But under the CARES Act, the banks had to offer these banks, FHA, VA, USDA, HUD, Fannie, Freddie, had to offer forbearances. Now, what the CARES Act also says is that at the end of the forbearance, they're not allowed to charge a lump sum. So they're not allowed to say, you've had 12 months of no mortgage payments, now you got to pay us 12 months in a lump sum. They're not allowed to do that. They can modify the loan. They can put a repayment plan in place. So a repayment plan would say, pay us double your mortgage payments for a year, and then you'll be caught up. Pay us 1.5 of your mortgage payments for 3 years, and then you'll be caught up. Or maybe they'll just modify the loan, take the mortgage arrears, put it at the back end. I've talked a lot about this, like the banks did here in areas that were affected by Hurricane Irma. Maybe that's what they do, and that cures a lot of these mortgage deficiencies. But again, all of these moratoriums, all these executive orders, all these things that are in place do not relieve the homeowner, the borrower, of the responsibility of making their mortgage payments. At some point, we got to pay the piper. At some point, we can't keep kicking the can down the road. Now, again, the CARES Act only applies to these types of these types of loans. If you are a real estate investor and you did private lending, or if you're a homeowner and you did private lending, seller financing, some of those other issues, these moratoriums, these executive orders do not apply to your lender. So hard money lenders can foreclose. Seller finance mortgages can foreclose. Investor quality loans can foreclose. So if you have a Freddie mortgage through Chase, they cannot. If you have a non-owner-occupied loan through Chase, they could foreclose if you don't make your payments. So again, this doesn't apply to investor loans. Now again, maybe you bought your house using a Freddie Mac loan, and then you bought a second house and moved into that second house and you put tenants in the first house. Well, Freddie Mac doesn't necessarily know that house number one is no longer owner occupied, assuming you stayed there the required length of time. You stayed there, 2-3 years, a year, 2-3 years, whatever, and then you moved in a tenant and moved into a new primary residence. Freddie may never know that it is not an owner occupied home at that point. But if they do, if they find out, theoretically, they could then foreclose. But chances are, if you're a forced landlord, for example, or if this is a strategy of yours where you're going to buy a house as owner-occupied, live in it for 2 years, move into another house and rent out the first house, and Freddie finds out, they can foreclose. It would no longer be a Freddie Mac program loan at that point, and so CARES wouldn't apply at that point, and they can foreclose. So be careful there. Now, interestingly, I had a friend of mine send me a mortgage data information from November 2020, and it was by a company called Black Knight. And so I want to read here. Black Knight is an award-winning software data and analytics company that drives innovation in the mortgage lending, servicing, and real estate industries, as well as the capital and secondary markets. Businesses leverage Black Knight's robust integrated solutions across the entire homeownership lifecycle to help retain existing customers, gain new customers, mitigate risk, and operate more effectively. If you want to see some of this data that I'm about to reference, you can go to blackknightinc.com. So again, all one word, Black, B-L-A-C-K, Knight, K-N-I-G-H-T, Inc., I-N-C.com, blackknight.com. But here's some of the data that I got from Black Knight from November of 2020, as of November of 2020. And it's kind of interesting. So what it says here, number one, despite seasonal headwinds, mortgage delinquencies improved, so less loans delinquent for the sixth consecutive month in November of 2020, falling to 6.33 from 6.44 in the month prior. Now, here's the interesting point there, is that in a normal economy, I believe that mortgage defaults are around 3 to 4%. So mortgage defaults, mortgage delinquencies are still higher than they would be in a normal market, but they are falling. Number two, the national delinquency rate is now down 1.5 percentage points from its peak of 7.8 in May, but remains a full 3 percentage points above pre-pandemic levels. So again, that's just an acknowledgement that we're not in a normal economy. We are in a recession economy with the level, at least looking at the level of mortgage delinquencies. So it is falling, but it is still higher than it was pre-COVID. Number three, while early stage delinquencies, which are borrowers 1 or 2 payments past due, have fallen back below pre-pandemic levels, seriously past due, meaning 90 plus days, remain 1.8 million above pre-pandemic levels. So what that means is some of these borrowers are getting back on their feet, they're getting new jobs, they're getting unemployment, they're getting some of the stimulus money, whatever it is they're getting, they're only falling a month or two behind before they're able to catch up. But once you get to that 3-month behind level, there are a ton of mortgage delinquencies. Again, I mentioned before, kicking the can down the road. We got 1.8 million mortgages above pre-pandemic levels. That's not 1.8 total. That's 1.8 million above pre-pandemic levels that are seriously past due, meaning 90 days or more delinquent. Number four, foreclosure activity remains muted as widespread moratoriums remain in place. Again, I just talked about that. Banks are not foreclosing. Some investors are. Some private investors, hard money lenders, seller finance lenders, they are foreclosing. But by and large, the big banks, the Freddies, the Fannies, the FHAs, USDA, Chase, Bank of America, Wells, etc., those guys are not foreclosing right now. In November of 2020, there were 4,400 foreclosure starts and 176,000 loans in active foreclosure. But those are both at their lowest levels on record since Black Knight began reporting the metrics in 2000. Again, I think just an indication that foreclosures are down because of these moratoriums. But again, we're kicking the can down the road, and that really worries me. And then last, prepayments fell 11% from October's 16-year high. However, with interest rates at record lows and refinance incentive at an all-time high, prepay activity is likely to remain elevated in the coming months. And again, this is just a function of, with interest rates as low as they are, a lot of people have equity in their homes, and so they are choosing to refinance, potentially to get rid of that mortgage default. They're choosing to refinance, choosing to lower their interest rates, choosing to lower their payments, choosing to lower maybe their repayment terms. And so that's an indicator there. Now, I hear rumblings that mortgage rates are starting to tick up. So I would suggest talking to your mortgage originator if you have further questions. I've got a few that I can I can refer, one of which, Bill Mantooth, was on the Crushing Debt podcast, one of our bonus episodes when COVID started. So you can look at his episode. You can contact him. But again, I think mortgage rates are starting to tick up. I think inflation is going to start to tick up. I think some of these things are going to start happening here as we continue to kick the can down the road. So we'll see how they develop. Again, if you have mortgage issues, whether you're a lender that has questions about can I foreclose, whether you're a homeowner that's scared about how can I catch up this mortgage deficiency, contact my office. That's what we do. I've been doing this area of law since 2001 on both sides, and so I can help one way or the other. The last thing I want to talk about are student loans. Now, the CARES Act put a lot of stuff in place for student loans. The CARES Act suspended payments, interest, and collection on all student loans. Now, again, I understand that was extended to January 31 of 2021 by President Trump. What I don't know, what I didn't hear, is that whether the student loan moratorium, collection moratorium, was extended. Now, I assume if evictions and foreclosures are extended to March 31 of 2021, I assume student loans will be as well. The three of those seem to adjust together. But I don't know. The other thing I don't know is about student loan repayments or student loan relief or student loan forgiveness. That's the other thing I don't know, but I can find out and I can update everyone on a future episode as soon as I know more about whether the newest relief packages will include a waiver or a payment of student loan obligations. I'll keep you posted there. CARES Act only applies to federal loans held by the U.S. Department of Education. So it does not apply to private loans. It only applies to federal loans held by the U.S. Department of Education. So that also means it doesn't apply to loans not held by the U.S. Department of Education. So loans held by the U.S. Department of Education can be direct loans originated by the Department of Education or FFEL loans and Perkins loans turned over to the Department of Education for collection. Now, what's an FFEL loan? An FFEL loan is a federal family education loan. Basically, it's a federally backed loan originally funded by a private company and now turned over to the Department of Education for collection. So, again, these moratoriums, these ability to not pay, only applies if you have a loan held by the U.S. Department of Education, originated by the U.S. Department of Education, or an FFEL loan. So again, it suspends payments, interest, and collection on those loans. Now, interestingly, one of the best ways to cure a student loan default is something called an IDR, income determination. Basically, you're submitting to your student loan lender your income, and then based on your income, they will set a payment for you. Now, that payment is not designed to pay off the student loan unless your income supports that. And again, depending on the type of program, after 20 to 25 years, the income-driven repayment plan will terminate. And so after 20 to 25 years, if you still have a balance owed, that balance is forgiven. And so IDRs are great ways to negotiate your student loan payments. Now, under the CARES Act, typically you have to recertify your income levels annually. The recertification deadlines have been extended under the CARES Act. You can request recalculation now during the pendency of the CARES Act and the executive orders. And at least for now, payments are not due until February 1 of 2021. Now, again, I don't know if this was extended by executive order. If it was, then payments would be due April 1 of 2021. Now, here's what I get a lot. Here's the question that I have a lot. If you have a performing student loan, no IDRs, no missed payments, you got your bill, you've been paying it every month, and it's current, and it's a federal loan, I would continue to pay it, even though the CARES Act suspends payments, because they've also suspended interest. And so if you're paying that student loan, then you're paying down pure 100% principal. Every payment you make pays down principal. And so you can come out of the other side of the CARES Act owing a lot less on your student loan because interest is suspended while we're in the CARES Act and whatever executive order extensions. But if you're on an IDR, if you're on an income-driven repayment plan, past due interest is still owed. So any payment you pay is really just going to pay down the interest that you owe. Because remember, typically at the end of an IDR, there's a lot of money still due on that loan after the 20 or 25 year period. So all your payments, really all they do is pay down interest. Well, at the end of the 20 or 25 years, that interest is going to be forgiven anyway. So in my opinion, there's really no benefit to paying right now, while the CARES Act and the moratoriums and the extensions and the executive orders, while all of that applies, there's no benefit in my mind to paying your IDR. Now, you obviously don't want to be in default. I'm not telling you not to pay your student loans, but what I'm telling you is the CARES Act suspends interest, payment, and collection. And so if you have a loan that's on an IDR and it is a federal loan and it is governed by the CARES Act, in my opinion, I don't see any need to make your IDR payments until the CARES Act ends, until the moratoriums and the extensions end. Now, obviously, I am not giving you legal advice to stop paying. If you have specific questions about your student loans or your student loan situation, contact me, contact a local attorney, contact an attorney that has some area of specificity in student loans. I've interviewed Josh Cohen on my show. He knows a ton about student loans. I've interviewed Christy Arkovich on my show. She knows a ton about student loans. Reach out to one of these two attorneys if you have any questions before you take my blanket advice and stop paying on your IDR. Reach out to one of these people. Reach out to me. Let's go over it in detail and see if we're going to get you into any more hot water by giving you that advice before you stop making payments on your IDR. But if you have a performing loan and you've been making your payments on time every month and it is a loan covered by the CARES Act, I would suggest you pay it, because that way you're paying down principal. And when we come out of the other side of this, you're going to owe less money on your student loans. So that'll do it for this week's episode. Again, my intent was not to make this week's episode political. Who I voted for, who I didn't vote for, who I agree with, who I disagree with, none of that really matters. What I was trying to do is give you the information that you need to make decisions about what do I do about my tenants that aren't paying? What do I do about my landlord that's trying to get money from me? What do I do about my mortgage borrower that isn't paying? What do I do about my mortgage? I'm not getting my payments. What do I do about my student loans? All while we're in this COVID, CARES Act, governmental transition, all while we're in this time, how do you take care of your finances? How do you take care of your family? That's what today's episode was designed to provide to you. So with that, as always, I appreciate your listening. I appreciate your feedback. If you have specific feedback on this episode, please let me know. If you want ideas about how to increase income from other sources, if you want information about how to decrease other expenses, I mentioned even before talking about the CDC guidelines, can you cut the cord? Can you do other things to decrease your monthly expenses? If you want information about that, you can find that in my latest book, Become Debt Free in Less Than 1 Hour. Again, you can find that www.seanmyesner.com/become debt free. I'll put that here in the notes as well. As well as the BlackRock information, so you can look that up for yourself. Again, I'm not promoting or I'm not advocating for the accuracy of this information from Black Knight. Feel free to go on their website and make up your own determination as to whether their information is accurate or not. It was just information that I saw that I thought might be helpful in today's episode. So with that, I think that'll do it. Like I say at the end of every episode, and especially with today's episode, I hope that you have more money at the end of the month and not more month at the end of the money. That'll do it for this week's episode, and we look forward to talking to you in next week's episode of the Crushing Debt Podcast.
If you have questions that you think would make a great topic for a future episode, please email Sean or connect with us on social media. Sean Yesner and Yesner Law, PL, are Florida licensed attorneys. The information contained in this week's episode is not a substitute for legal advice. Your situation may differ, especially if you are located somewhere other than the state of Florida. If you have questions, please contact our office or contact a local attorney. Thank you for listening to this week's episode of the Crushing Debt Podcast.